Welcome back in, ladies and gentlemen. In this video, we're going to just get right into it. We're going to talk about a lot of stocks that are showing a tremendous amount of value. Now, before we get into today's video, I want to highlight something here. One of the stocks that I talked about 7 months ago, trading around $25.50, only got 335 views. I called out a company named Dutch Brothers. Fast forward today, and Dutch Brothers is now approaching $36 a share. Nobody wanted to watch it. Nobody wanted to like it because I wasn't talking about SoFi or Palantir when this was a growth giant in the background that was getting ignored. And the crazy thing is there's some tremendous growth opportunities, but the problem is the only ones that are getting views are the ones that everybody wants to talk about. And so there's a tremendous amount of value in this market. We're going to get into it. Now, this recent vertical jump on Dutch Brothers, I think, is getting to an extreme. It'll probably cool off here, pull back, but we could see new highs coming in as more upgrades are coming. So this is not one that I recommend jumping into now, but an interesting stock right now is going to be Gilead Science. This was one that I like around $65 a share, could possibly get into the high 50s, paying nearly a 5% dividend. This is a very interesting company. Gilead has many focuses from HIV detection, hepatitis C, but their bread and butter is really with cancer treatments and oncology, and this company is set up pretty nicely here. With all the weight loss treatment talks going on, this one's kind of fallen in the background, and I still think the pipeline could be very strong in this company. Now, of course, this could be a high risk, high reward, but I kind of think it's a low risk, sizable reward here, especially factoring in a dividend that we can reinvest into those gains, where I do think we could see this company hit newer highs sooner than later. Recently, this company nearly touched $90 a share, and it's back down to $65 a share, which is showing a lot of upside still available in this company. They basically had a kitchen sink quarter, but as we can see here, total revenues are still in the incline, going from $24.6 billion of top line revenue now to $27.4 billion of top line revenue. But obviously where they're dropping the ball is going to be earnings per share. And on this channel, we talk about stock price does follow earnings per share. And so that's why we've seen the recent fall off from $89 a share down to $65 a share. But with the recent pipeline and the clean balance sheet that this company has, this is going to be one to watch. When we look at total debt going from $31.4 billion down to $25 billion of debt, they're reducing their debt, they're growing their top line revenue, and now it's just a matter of all pieces coming together to regain that stock appreciation. But you get paid a decent amount to wait on this one. Almost 5% yield on this one. And we can see for the last 8 years they've paid out this dividend. In the last 8 years, they've also raised this dividend. So we have a dividend compounder with possible stock appreciation growth as well. So this one is definitely one to put on your watch list. Next up is going to be SWK, Stanley Black & Decker. This stock was trading for over $200 a share, now trading at $89 a share. I'm going to give you an ideal price target here in 1 minute, but a few things I want to talk about. When we talk about the Infrastructure Act taking place, we talk about the housing shortage. Stanley Black & Decker has multiple tailwinds coming in the very near future that could grow revenues and stock appreciation. Once again, this one does pay a dividend, 3.68% dividend. They raised that dividend for 55 years and paid that dividend for 55 years. And at these levels, this one could be an extreme compounder for a long-term investor. For me, Stanley Black & Decker is almost sitting in a buy zone here. I want to get it closer to $75 a share. As you can see here, from a free cash flow standpoint, I'm looking at closer to $50. And from a multiple of EBITDA, right around $82. And 70 in the high 70s is where I get very, very interested in this company. And the reason being why I'm building so much safety in this one and I'm not buying it today is going to be the debt. This company had $3 billion in debt just a few short years ago, now pushing $7 billion in debt. And in a higher interest rate environment, a consumer slowing down, there's also some headwinds with this company. But in my opinion, at the right price, this one becomes a good risk first reward. So Stanley Black & Decker is definitely up there as well. And for my long-term subscribers, the Gen Digital, the one that I told you to buy around $15 or $16, now trading at $23.40, up 15% on the day. This one, once again, pays a nice dividend and has done everything right. They're doing a massive buyback, growing EPS, and this just goes to show that fundamentals will eventually show themselves. Now, normally I hate restaurant companies, but we're going to talk about one that is a micro cap. This is under a $1 billion market cap. It's actually under $500 million market cap, and that is Chewy's holding. You can see after reporting earnings, the company is down 6%, trading right around 14 to 15 times earnings. I went over their report and they've had negative 5% year over year sales, But there was a lot of things I liked about this company. Number one, they got rid of all their debt, meaning this is a completely debt-free restaurant company. That is very, very rare to see in the restaurant business. A lot of these restaurant companies carry a substantial amount of debt and very low margin business. Not only do they have no debt, but they buy back stock, going from 18 million shares outstanding now to about 17.4 million shares outstanding. They have $56 million cash on their balance sheet and $25 million of revolving debt. So overall, liquidity profile on this company seems pretty decent. They recently guided down, going from $1.97 to $1.87 down to $1.82 to $1.87. And so let's just say the stock's trading around $28 divided by $1.85. We'll meet in the middle. We get right around 15 times forward earnings, historically in line for a lot of these restaurant companies. So where's the value add here? The value add is they have no debt, they're free cash flowing, and on top of that, they currently have 102 locations with the opportunity to open up 6 to 8 more new locations. So they're basically going to add 8% to their current portfolio of restaurants. They had a down year, the stock is down, and it's trading for a reasonable valuation when the company has no debt and some cash on the balance sheet. To me, this looks like a pretty good growth opportunity for a company that's getting discounted here. Of course, this is a very low cap company, very low float company, which means it could be manipulated very easily. And if there's any sort of selling pressure, we can see ridiculous valuations here. As you can see just by the chart, the stock has been as high as $48 a share and as low as about $9 a share, currently right around $28 a share. The stock gets interesting. Sitting right around $20 to $28 a share, I think somewhere in this range makes a lot of sense for the valuation of the company and the opportunity growth ahead. So I gave you some high risk stocks and some stocks that I think are fairly safe. And so hopefully you guys enjoyed that quick dive in of stocks you need to be watching. As always, appreciate your time. We will see you in the next one.